There is a game played on Wall Street every 10 years. It's called Pass the Bag. In 1999, it was dot-com stocks. In 2007, it was mortgage bonds. In 2021, it was SPACs. In 2026, it is AI IPOs. You are going to see a flood of artificial intelligence companies going public this year. The media will hype them. The bankers will sell them. Your neighbor will buy them. They will tell you this is the new industrial revolution. But the smart money asks one question. Why are they selling now? If these companies are money-printing machines, why are the founders and VCs so desperate to give you their shares? The answer is terrifying. They know the hyper-growth phase is over. They know the technology is hitting a wall. They are cashing out. And they need someone to hold the bag when the price corrects. That someone is you. To understand why they are selling, you have to understand the scaling law. For 5 years, the rule was simple. Add 10x more data and compute, get 10x smarter AI. It worked for GPT-3. It worked for GPT-4. But recently, reports have leaked from the major labs, OpenAI, Google, Anthropic. The curve is flattening. GPT-5 is costing billions to train, but it isn't 10x better. It's maybe 10% better. We are hitting the law of diminishing returns. We have run out of high-quality human data to train them on. The insiders know this. They know the dream of artificial general intelligence, AGI, might be 10 years away, not 2 years away. But the valuations are priced for AGI tomorrow. This gap between expectation and reality is the bubble, and they want to sell before you realize the progress has stalled. The second reason for the exit is the wrapper crisis. 95% of the AI startups you see are just wrappers. They are thin user interfaces built on top of ChatGPT. They don't own the brain, they just rent it. They raised billions of dollars to build AI for law, AI for copywriting, AI for coding. But then, the platform giants woke up. Apple released Apple Intelligence for free. Microsoft integrated Copilot for free. Suddenly, that $50 a month startup is a free feature on your iPhone. This is called getting Sherlocked. The VCs know their portfolios are full of zombie companies that have no moat. They are rushing to IPO these companies now to get their money back before revenue goes to zero. They are selling you a blockbuster video franchise in the age of Netflix. Let's look at the math of an IPO, initial public offering. The name implies it is the beginning. In reality, it is usually the end of the easy money. Private equity and VCs get in at a $10 million valuation. They grow it, they hype it. By the time it hits the stock market, IPO, the valuation is $10 billion. The VCs have already made 100x their money. They are selling to you at the peak of the hype cycle. To make money on an IPO, the company has to grow from 10 billion to 100 billion. That is infinitely harder than growing from 10 millions. History shows that buying hot tech IPOs is a losing game. Look at Peloton. Look at WeWork. Look at Rivian. They IPO'd at the peak. Retail investors bought the hype. The stock crashed 90%. The VCs bought the yacht. You bought the bag. Even if you buy the IPO and it goes up, there is a trap waiting for you. It is called the lockup expiration. When a company goes public, the insiders, employees, and VCs are not allowed to sell for 90 to 180 days. They are locked in. During this time, the supply of shares is low, so the price stays high. But the moment the lockup expires, the floodgates open. The insiders rush to the exit. They dump millions of shares onto the market. Supply overwhelms demand. The price crashes. We see this pattern over and over. If you buy an AI IPO in 2026, mark your calendar for 6 months later. That is the day the people who built the company are planning to dump it on you. Who is driving this valuation madness? Often, it is one or two massive whales, like SoftBank or Saudi sovereigns, who are pumping the private market valuations. They invest $100 million at a $1 billion valuation. Then they invest $500 million at a $10 billion valuation. They mark up their own books, episode 28. But eventually they run out of money. They need a greater fool to buy them out. The public market, the 401ks, the pension funds, the retail traders, is the greater fool. They are inflating the balloon privately so they can pop it publicly. When you see an AI company with $10 million in revenue and a $5 billion valuation, run. That isn't a company. That is a financial weapon designed to extract your wealth. Let's summarize the investigation. The IPO wave of 2026 is not an opportunity. It is an exit strategy for the elites. The smart money playbook: 1. Don't buy the IPO. Wait. Let the price settle. Let the lockup expire. 90% of IPOs trade lower 12 months later. 2. Audit the revenue. Is the revenue real or is it circular? Episode 28. If the customers are other VC-backed startups, it's a house of cards. 3. Watch the churn. If users try the AI app once and leave, it has no value. Retention is the only metric that matters. 4. Short the lockup. Advanced traders can buy put options before the lockup expiration date to profit from the insider dump. The party is ending. The bill is coming. Don't be the one holding it. This is the smart money wisdoms. The future belongs to the owners. Thanks for watching. Like and subscribe. See you next time.